This is Stay Smart, Stay Ahead Property Podcast, where we cut through the noise and focus on what actually matters in property and investment. Welcome back to Stay Smart, Stay Ahead Property Talk. I'm your host, Gianni Salvatore, and it's great to be back in the studio. On our last episode, we broke down how to buy a property with a friend, specifically how to pull your money together to get into the market faster without ruining your friendship, and most importantly, with a product where you don't need to argue over who gets the master bedroom or sharing an ensuite. One property living independently. We had a ton of feedback on that, including a quick question from Sarah in Melbourne. She asked, "My best friend and I want to buy together, but my friend has a bigger deposit than me. Do we still split the profits 50-50 when we sell?" Sarah, great question. The short answer is no. She puts in more money up front, she earns a bigger slice of the pie. But what we say is keep it simple. Put the exact percentage split down on paper from day one. That way there is zero complications. You both own 50-50. Protect the friendship first. But look, if co-buying with a friend sounds like too much drama, that brings us perfectly to today's topic, rent vesting. I have Franco Bevacqua with me here in the studio. Welcome, Frank.
Yes, thank you, Gianni. Good to be here.
Great to have you here. Franco Bevacqua, CEO of Charles Lee Property Group, over 40 years of experience in property, real estate, and the building game, an abundance of experience there. Frank, you've also witnessed the recession in the 80s, the global financial crisis, the global pandemic, the war on Iran, interest rates hikes. You've seen it all. Are we in a good position now, or are we in a bad position with everything that's going on in the world?
Well, with everything that's going on in the world, it's not a great position to be in. But economically, on the property side, I think now's the only time to buy. It's the best time to buy. My experience tells me that buyers are like sheep. When everyone's overpaying, and because the media is saying that you should be out there buying, they go in and they buy and they spend too much. Today, we have a much more placid market where prices aren't increasing rapidly. They've stabilised, and the market is there for you to go out and buy sensibly and make the right choices and decisions.
That's why I'm glad to have you in the studio today. With all that experience, you summed it up in one sentence. Buyers are like sheep. When the price is high, they're all jumping in, they all want to buy. But today, it's a placid market. It's Correct. A good time to get in. It's good to have you here, Frank. Rent vesting is the topic for today. Can you explain to me what rent vesting actually is?
Well, rent vesting is nothing really particularly new. It's just that there's a new buzzword, rent vesting. Okay, so rent vesting simply means that you're going to rent where you love. You might be living in Caulfield, St Kilda, wherever it may be. So that's where you want to be, where all the bars and the cafes are.
Yeah, that's right.
But you want to invest in places where there's growth. So where's the growth? The growth is in the regions. You hear government saying, yeah, look, we've got to invest in our regional towns and also in the growth areas of Melbourne. So, and that's where governments are focused in putting in all the necessary infrastructure, schools, shopping centres and alike. So you're then, and it's brand new.
Yeah.
So as an investor, you get all of the benefits of buying brand new.
And buying brand new doesn't seem that exciting anymore, because I listened to the budget a few weeks ago and they've wiped out the beauty of negative gearing and capital gains discount. So why would I still buy an investment property? What is in it for me?
Okay. Well, if you're buying an existing property, which is an established property, say a little 1970s two-bedroom unit in, say, Blackburn or wherever it might be, well, no, it doesn't apply there at all. But in brand new, it does apply. You still have the negative gearing. You still have the capital gains tax deduction. You still have the depreciation allowances. So it's all still there. And on top of that, builders are highly more competitive in producing more competitive stock today.
Yeah. So you're telling me, because I'm just going off what I see in the market, or in the media, should I say, and a lot of other people do. There's bucket loads of articles out there about this budget, and it all headlines just say negative gearing gone, capital gains discount gone. I can still build brand new as an investor and reap those benefits. And they're probably the three main ones you just said: a capital gains tax discount, negative gearing, and depreciation costs. I can still reap those benefits as an investor.
100% you can. But keep this in mind, you can't do it on established.
On established.
And you can't buy an established property, knock it down and build brand new. It has to be from scratch.
From scratch. And that brings me to my next point. You mentioned the builders are showing competitive pricing. With everything that's going on, the war in Iran, it seemed that the energy was focused on construction costs going up. But what I've also heard is that the builders don't have abundance of work on like they may have had 5 years ago. Is that true?
Yes, that is true. The detached housing industry is certainly different to what it was, let's say, 3 to 4 years ago. It's not hot. Builders can actually perform within the correct time frames now. Trades are becoming much more fluid and available. And look, there's a lot of talk about, material costs going up. Yes, they are, but they're not as drastic as what they were perceived to be. And we've had one of the largest builders in Australia, which recently put out an article that their average building cost is only on a detached house of about $400,000 to $500,000, only about $4,000.
That's all.
That's all.
Wow. So we're really being told something that's not true, saying prices are increasing at a rapid rate. There you go, a top Australian builder, a couple $1,000s over the whole build increase. That's all. So back to this rentvesting topic. The Australian dream, as we know, buy your own home, have the backyard, have the barbecue, have it all. But here you are saying, well, if you want to live in the city still or in a metro area, the entry level's still high. So you're perhaps saying, forget about the Australian dream, rentvest, buy in a growth suburb where there is government spending and still live where you want. Does that still help you get ahead if you're paying off someone's mortgage renting and you're still got a property out somewhere else earning money as well? Do they really catch up to each other?
Of course. Look, the reality is that it'd be lovely if you could have your property in the area where you love, but obviously that's not going to be economically. That's not going to be possible. So to get into the market, you need to think outside the box. There's no point saying yes. Look, if you're born and bred and you're living around the inner city, you're not going to go and live in Traralgon, or you're not going to go and live in Berwick or Clyde or Tarneet and some of these areas. So you need to make a decision as to get into the marketplace and put your foot in there. And as time goes on, and look, once you're in a property, don't think you're going to buy it today, you're going to sell it tomorrow and make a big profit. It's a long-term situation. So I think what you've got to look at, you say, look at your next 5 to 10 years, and you say, okay, I'll be renting where I love. I'll be living there, enjoying my lifestyle, but I'll have an asset which is appreciating out on the peripheries, either of Melbourne or in regional Victoria, and your nest egg is growing. So at some point, you'll then be able to realise that asset, get all those gains where you've got your discount on your capital gains, you've had your benefits of your negative gearing, so you've had more net income come into your pocket and paid less tax, and you've had all the depreciation allowances, and you come out and you've got a nice little nest egg, and then you go and buy in the area that you want and the house that you want.
I agree with you. It takes time, like you mentioned. And I guess the number one important thing to note there too is, like you said, if you're still renting where you love, well, if you buy in a growth suburb, you're going to have the capital growth over time, like you're saying. So build that nest egg, and then eventually, bang, you can go buy perhaps where you want to live.
Absolutely. And then once you convert that very tax-effective investment, when you go and buy your own home and you live in it, that's an even better tax-effective scenario where there is no tax once you sell it at a profit. So you've had all these benefits, these tax benefits that you've availed yourself to, as we say again, where you're getting the negative gearing, you're getting the CTGT tax benefit, and you're getting the depreciation allowance, and then you're putting that money into another tax-effective investment, which is your own home, which is totally tax-free.
It sounds like an absolute no-brainer. So I think I looked up the stat the other day. It was something like average age of an Australian that is buying their first property is 38, 40 years old. What would you say to those, call it 30 to 40-year-olds that are still looking in the suburb that they're currently renting in? What would you say to them? What's your advice that you would say to them?
Well, my advice, if you've got sufficient equity, and that can be around the 20%, I would say take that 20%, get into the market, start looking at investment properties, in new investment properties, that is, not established investment properties, and get into the market and start building your wealth now.
Yeah, Yeah, and a few episodes back, I met with Callie and Gary from the Dual Key Victoria team. I mean, imagine if you rent vested with Dual Key Victoria. There you've got one property, yet you've got two incomes, the 3-bedroom home and the rear unit. You're technically doubling your rent vesting potential.
Yeah, well, your return certainly blows out, which is fantastic. So we're talking probably about a 7% return with a dual key. But for those of you who don't know what dual key is, it's one property with two incomes. It has a main house at the front and a supported unit at the back with totally independent living. So you can have two tenants supporting your investment loan. But the beauty of this is that it's outside the box. I can tell you that in 40 years of being in the property industry, this is probably the best solution to solving the rental crisis, because you're providing two tenancies on one block of land. You don't have the impediments of town planning. It's an as of right use, so you can get straight to a building permit and get these straight. So the authorities are out of your way. In the industry, we say, we always talk about governments. Get the authorities out of our way. Let us do what we want to do. With dual key, we can do this and do it quickly, efficiently.
It's an amazing solution, and I'm shocked it's not happening everywhere. It's like people are scared. They want something different, but this is just so simple. It works so well. It's amazing. It really is. Now, these rentvestors, so a lot of people that I know, we get emotionally attached when we're looking for property. We want the marble top or the 20 mil thick bench top. When it comes to rentvesting, should we still be a little bit emotional when we're buying, or take that completely out and just simply think about the numbers?
Okay. Well, let's look at it. I think you need to be a little bit emotional, because you need to be aesthetically, you want to be able to present a product to the market which is appealing.
Yep.
So we don't want to get bogged down in let's go and do the most minimalistic, type of design or type of colour selection for the property. So what I would suggest is, no, don't get too emotionally invested. But yes, always be guided by, look, our builders are fantastic, and we have great colour selections. You can be guided through all sorts of different appliances and different tiles, bricks. So it's not an issue. So yeah, you can have a great input, put your creativity into the property, and certainly present it the way you want to present it to the market, but be guided by the professionals as well.
I think that's a good point, because a lot of first-time buyers, they still want to be involved. And I don't want people to take it the wrong way where we're saying rent vest, don't worry about the property. But like you said, still have involvement, still look at the colour schedules, still get involved in it, because at the end of the day, you're presenting it for someone else to live in. And ultimately, you want them to have a nice property, and you want to know you've built something nice as well. Frank, it's great to have you here today. Before we finish off, a lot of bad publicity in the media, a lot of bad articles, negative topics. What's your last piece of advice for the remainder of the year to give to the people out there in the market that are a bit unsure whether to jump in, not to jump in? What's a piece of advice you'd give?
Okay, the advice that I can give everybody is that wealth is not built by working as a PAYE taxpayer your whole life. You need to step out and you need to take some risks in life. Now, property investment is not a risk. It's a reward. And you just need to plan it correctly. And as we know that the rental market our population growth is high, so the rental market is hot. There's plenty of tenants out there. You're moving into new property. I would suggest new property is the only way to go. So that would be my suggestion. But looking back in hindsight, I don't think that anyone ever became a millionaire or a multimillionaire by saving $10 a week.
No.
I think they invested, they took risks, but calculated risks. We're not talking about, look, you can go and play Bitcoin. Now, Bitcoin, yeah, that's fine. You hear of all the you hear about tech millionaires, yeah, but this is something that we all understand. We can control it. We can realize it ourselves when we want. We can drive by it. We can see it. It's not a share, which is a piece of paper which someone else is handling. So my advice is to you at the moment, the way the market is, it's at the lowest it's ever been. We've got the lowest interest rates you can have. We've got government offering 5% deposit schemes and all sorts of wonderful applications for finance. So get out there, get into the market, and start your journey now in increasing your wealth by buying. More particularly, a biased view, buy a dual key. and Rentvest, but get out there and, certainly we would guide you every step of the way.
Of course. And that is a great piece of advice to give. Guys, if you're listening, take the risk, calculated risks, invest in property, and control the controllables. Franco Bevacqua, thank you again for being on the show today. It's great to have you. We will get you back on at some point. So thanks again for coming in the studio.
Okay. Thank you, Johnny. Great to have been here.
Very good. Thank you to our listeners. Guys, thanks again for listening. If you have a topic that you really want to know more about, please send in the topic and what information you want to listen to. We'll do our best to answer any questions. Thanks again. See you next week.